the Fed continued its rate cutting cycle in quarter four, lowering interest rates by a quarter point at both the November and December meetings for a total of a 0.5% interest cut. The 2 quarter point rate cuts were well telegraphed by the Fed and they were widely expected. But the big development in quarter four was the changing outlook for 2025. Despite the 2 rate cuts, Fed Chair Jerome Powell and the other Fed presidents indicated they are not in a hurry to cut rates further. This change in tone followed the U.S. economy's recent strength, which has caused the Fed to re-examine the need for additional rate cuts. Recent economic strength has also led the market to reevaluate its rate cut forecast. This dynamic can be seen right here in this chart showing the bond market, where longer maturity Treasury yields have risen sharply since the first rate cut in September. This graph shows the 10-year Treasury yield against the federal funds rate, which is the interest rate the Fed adjusts to set monetary policy. Since the first rate cut in September, the federal funds rate has decreased by 1%. Over the same period, however, the 10-year Treasury yield has had the opposite reaction, rising by nearly 1%. Now, this has confused many investors, so it's important to note that while the Fed controls shorter maturity interest rates, the market has more control over longer maturity interest rates. Now, what caused Treasury yields to rise as the Fed cut interest rates? Well, 2 key data points contributed to the Fed's decision to start cutting rates in September: falling inflation and rising unemployment. Inflation declined from 3.3% in July of 2023 to 2.6% in August of 2024, while unemployment rose from 3.5% to a high of 4.3%. The 2 trends caused the Fed to shift its focus from lowering inflation to instead supporting the labor market. However, since the Fed started cutting, the trends have reversed. Inflation progress had stalled since September, and unemployment has ticked back down to 4.2%. So heading into 2025, the Fed and the market have similar rate cut expectations, approximately 0.5% in rate cuts for the entire year. Now, the question is whether they're placing too much emphasis on recent trends and are underestimating the need for rate cuts. As both the Fed and the market saw in 2024, forecasting Fed policy is difficult, especially in this cycle. As a standard disclaimer, this video is for educational purposes only and is not intended to be financial or investment advice.